My instructions for what I was to do now were to reflect on the morning's discussion. And when you get those instructions in advance, you're never quite sure how the discussion will go and whether you'll feel energized or excited by it or a bit confused. But I have to say, I have found this morning incredibly energizing and hugely valuable, because it's made me think about the reality of how we deal with the challenge of making progress towards a low-carbon economy. I first got involved in the issues about a low-carbon economy actually 18 or so years ago when I was Director General of the Confederation of British Industry, and I shifted, I think reasonably effectively at the time, the policy of the CBI to take climate change seriously. But I think at that stage, many of us involved in the debate thought that we would make progress in the following fashion. There would be a global, legally binding agreement. That would then produce such a clear path, legally binding, that there would be a carbon price which would emerge or which would be enforced, and that through the European Emissions Trading Scheme, that carbon price would affect the action of people, and we'd know that carbon price through a futures price out in advance. It was a wonderful sort of neoclassicists, economists' vision of how you get change. And it was a story which was actually very attractive for businesses, because it took away from businesses or institutional investors the responsibility of scrappy decision making, because they would be able to say, well, what I always do is maximize shareholder value given a set of prices. Somebody's come along with a public policy intervention, they've changed the prices, they've priced in the externality, I've now got a new set of prices, I still just maximize shareholder value, and whoopee, we head towards a low-carbon economy. And I think what we've heard today, and we heard first of all from Christiana, is it just isn't as simple as that, getting change in this arena. It's turned out a lot more complex. The EU Emissions Trading Scheme, on which a lot of us focused a lot of attention, has frankly been, so far, a disappointment. The carbon price going forward is unclear. There is a lack of an absolutely clear global legally binding agreement, and that's still probably going to be the case beyond Paris. And that is a disappointment, and that is part of why, in some senses, we've made less progress than we might have hoped. And that less progress, let's be clear, should be a wake-up call to us, because again, Christiana in her speech said that the new targets that we are getting out of Paris might keep us below 3 degrees. That's quite a major shift in our assumption about what we can achieve. And I think all the climate models suggest that in terms of the harm to human welfare, there's a huge difference between 3 degrees and 2 degrees. So we are in a danger of a situation where the glass is now definitely half empty. But it's also, I think, half full, and I think Christiana is quite right, is getting fuller. Because progress, it turns out, comes in a different, scrappier, more multifaceted way. It becomes because we slowly build awareness that this climate change is for real and it is dangerous and that people have to change. It comes because, partly stimulated by that, a set of technological developments occur which frankly amaze us and which we did not anticipate. And Mark Lewis talked earlier about how the pace of the reduction of solar PV costs has astounded us all. Certainly when I chaired the Climate Change Committee, when we began our work in 2008, we totally failed to see that extraordinary good news of the collapsing price of solar PV. Change happens because you get an accumulation of national actors who are willing to take action, and I think the major steps forward in China's policy on climate change over the last 5 years is a very positive factor. And then it occurs, and Anthony said this, Anthony Hobley, because at the international level, it isn't that we suddenly write down a not previously existing legally binding agreement. Essentially, we codify, reinforce, and subject to peer pressure a set of national agreements. And that is what Paris is about, and that is why Paris will be useful, even if it isn't a Kyoto 2 in that precise fashion. And when that happens, what you get is a process of change, whereas Sarah Butler-Sloss said, norms change. What is socially acceptable changes. What is acceptable in terms of intellectual denial changes, but what also changes is it becomes socially acceptable for businesses in high fossil fuel areas to simply say, nothing to do with me, I'll avoid it. It is a scrappy process, it is an imperfect process, but it is a process which works or can be made to work, but it means that business doesn't have the option of saying, okay, you, the politicians, tell us the plan, tell us what the carbon price is, and we'll simply respond to the carbon price. It means that a responsibility then falls on business and on institutional investors and on asset managers to be participants contributing to the development of this self-reinforcing, multifaceted process, rather than simply saying, somebody else does it, and I respond to it. And I think that does create, and that's what we've been discussing this morning, a different environment for the investment institution industry and the asset management industry. And that industry has to get to grips with two realities, one of which is about threats to existing businesses and the other of which is huge opportunities. The threats to existing businesses are all those which could be stranded by their high carbon nature, either because they're fossil fuel producers or because they're producing cars or consumer appliances which are energy inefficient. On the fossil fuel side, the simple fact that we have to keep coming back to is that if we are to have any chance of limiting the growth of temperature to below, say, 2.5%, let alone 2%, we are going to have to leave 2/3 of all known fossil fuel reserves in the ground. And we're going to have to leave them there, even if at a particular point in time, the marginal cost of taking them out seems to be the cheapest thing to do. And it's as simple as that. And if you don't engage with that fact, you're not really being serious about climate change. And the point that Carbon Tracker has made, and I think it is a wonderfully brilliant piece of analysis that Carbon Tracker have done, is simply saying there's a group of people who aren't being serious about this. They go to political meetings and they say, yes, yes, we're interested in heading towards a low-carbon economy. Yes, we believe in these political agreements. But then we are going to declare reserves which assume that we can take all of the fossil fuels that we've got out of the ground and do not face the reality that 2/3 of them will have to stay in the ground. I think this is a crucial issue, and it is an issue of financial risk. Let me be clear about this, because I was chairman of the Financial Services Authority and chairman of the Climate Change Committee. People expect me always to muddle up these two things in my brain, and sometimes I find it useful to be separate. I don't think we will see a financial crisis from climate change remotely like what occurred in September 2008. Right? This is not going to be on one day one thing happens, another day another thing happens, and then you're sitting telling the banks that you'll have to nationalise them, and the Bank of England has to provide, 300 billion of liquidity support. It just doesn't happen that quick, but it can happen quite quick. And again, Mark Lewis made this extraordinary point, which really struck me earlier, that 10 years ago, nobody anticipated that we could see utility shares go down, lose their 60 or 70% of their value because of some of the developments which would occur. So no, it's not going to be financial instability in the sense of that by September the 30th, 2008, we were in a completely different position from September the 13th, 2008. But we could see very, very significant movements in share price, which are a major hit to those companies and which are a major hit to the investors who have failed to see the challenges coming. And those challenges may, as Abid said in the first session, involve legal challenges. And I think those legal challenges may, as they have in the tobacco industry, somewhat relate to a responsibility that resides on business to take things seriously once the science is there already. And once it's clear. Nobody really criticizes somebody selling cigarettes in 1930 for selling cigarettes because we didn't know the truth about what cigarettes do. But once you get beyond the warnings of the American Surgeon General back in, I think it was 1958 or so, or about then, which said there is an undoubted link, then it became a legal process to say, you have some responsibility for what you're doing now. And once we are in an environment, and we are in that environment, where we know that there is a clear legal, environmental impact of excessive fossil fuels, I do think there is an issue as to whether there will be, at some stage, legal challenges. And I think that poses a question, as James Cameron put it, for the lobbyists, that if the lobbyists of industry simply think that their role is always to be a drag anchor on change, always to be a drag anchor, for instance, on honest emissions testing standards, rather than saying we commit to honesty on emissions testing standards, they must then accept that society may come back at them and say that is something that we can legitimately have a shot at trying a legal charge against. And I don't think that that in any way suggests that one should be ashamed if one is an institution which previously in the past made money out of fossil fuels. I was struck by the phrase earlier that somebody said that they were confident that Rockefeller would now want to get out of oil. I did an interview with German TV just before I did the initial introduction, and they said, isn't it a bit ironic that the Norwegian Sovereign Wealth Fund is leading in disinvestment, having made all its money out of wealth, out of oil? And the answer is no, it isn't, because the whole of humanity is going to use the benefits of fossil fuels to move beyond fossil fuels. We would not have had an industrial revolution. We would not have achieved the breakthroughs in prosperity that we had, which then enables to invest in science and in technology without the fossil fuels. If there had not been coal in Britain in the 18th century, we wouldn't have got to where we are today. But that has precisely given the science and technologies for us to move beyond that. So we should not be at all worried about this. Isn't it odd that we've used fossil fuels in the past? Isn't it odd that the Norwegian Sovereign Wealth Fund made its money? That is precisely what humanity was in a project about, to use the wealth and prosperity and technology and science, part of which came out of fossil fuels, for the next challenge, which is to move definitively beyond them. So that's part of the challenge, to move beyond fossil fuels. But the other challenge, which I think has been talked about today, which institutional investors and asset managers need to engage with, is the opportunities, the realization that there are all sorts of technologies coming down the path, many of which will be disruptive, many of which, by the way, some people will lose a lot of money in. All new technologies, you lose a lot of money. A lot of people lost money in 19th century railways, and a lot of other people made a huge amount of money. And a lot of existing incumbent players, as somebody said earlier today, get wiped out by that, and wiped out far faster than they first thought. And the institutional investors and asset managers industry, in order to serve the interests of their clients, has really got to be thinking about where those opportunities exist, because some of those opportunities will be the massive returns, which are often crucial to a total portfolio return. And some of them also will threaten existing incumbent players who, like, and various people talked earlier about Blockbuster, etc., will suffer far faster diminution in their share prices than incremental analysis driven by quarterly models of earnings will ever predict. So the pace is occurring. It's still inadequate. It can be made faster. It will not be made faster by one group of people in the world, the political leaders, sitting down, writing out what the agreement is and telling it to the rest of us as tablets of stones. Nor is it going to be delivered by one silver bullet like a particular emissions trading scheme or a particular commission to a carbon price. It's going to be multiple actions which are self-reinforcing, multiple changes in social norms, changes in investor behavior, changes in company behavior, individual behavior, reinforced by politicians, and then reinforcing what individuals and institutional investors and companies do. And Helena Morrissey said that we can't simply wait for a perfect framework, that there has to be a responsibility on industry and the industry represented here, institutional investment and asset management, to also play its role. We need to commit to taking the actions which, along with all the other multiple actions, in a scrappy, organic, non-linear fashion, take us in the direction which we need to go. I have found, listening this morning, very energizing, and it's helped me crystallize that that's what we're really saying. I hope it's also energized you and made you feel incentivized and encouraged to take action. Thank you very much.